What's up, Brandon? How you doing?
I'm doing well, Ryan.
So long time coming that we finally got you on the show. You've been watching all of this for many years. And so you and I have known each other for 8 some years now. And for the listeners that don't know all of our background or who you are, what you do, or where you came from, why don't you just go back to the day that you jumped into finance and got your drinking through the fire hose experience?
Sure. So I'll try to keep it as short as possible. But basically, even in high school, I knew that I was a numbers guy and that solving problems with numbers was a passion that I had. So I really took that to heart with my studies. Got a degree in financial management from St. Thomas in town here. And my first job out of college was with Cargill Treasury Operations. And so, clearly a much bigger scale than most people are used to as being, still the largest privately held company in the world, I believe. But this is back in the late 90s and in 2000 when the market was going up and people really couldn't do any wrong by investing, and really risk was just kind of a figment of everybody's imagination really at that point because nobody was really encountering it. Well, when I started with Cargill, they had a catastrophe. It was a foreign currency catastrophe, and it cost the company a significant amount of money. It was in the many millions of dollars. And that was the start of a wave for Cargill specifically of trying to get your head around of risk and risk management. And so my experience in the financial management industry was revolving around helping this incredibly large company get a grip on the risk and exposure that their individual traders were taking on a daily basis.
So, I was going to say, so you, I think from the stories that you've told me, it was literally managed on a spreadsheet, and these people were like so exposed into specific currencies or specific things. So they just thought immediately that their returns were going to happen. So they didn't even have any kind of concern that they weren't going to get their money back.
Well, so what Cargill was doing is they were just letting people really wildcats. So they had all kinds of different traders who were trading in everything from currencies to commodities. They had people who were working with distressed real estate, and really everything was to the upside. Everybody was making money, and it was the running joke was who was really blowing the cover off the ball that day. And so there was never a real serious conversation around what's our exposure here. And so when this huge loss took place, they had to start cutting staff, and the trading floor started to shrink. And the spreadsheet really was developed as this panic was happening. And that is let's get this thing on paper here and find out, what we're really looking at. And so, I don't know what Cargill's compliance department looks like today, but my understanding is that it's enormous. And really, I was on the front end of that. I was the only person at Cargill, the entire company, who was trying to govern these traders. And they really didn't appreciate my effort very much at all.
Lots of FUs and phone hangups.
There was. And it was really setting up just guardrails and saying, okay, this is where you've been operating at. You've been successful with this level of exposure. Here are some parameters that we're just going to keep our eye out for. So if you blow over it, if all of a sudden you're double, triple, quadruple your past exposure, which we're arbitrarily comfortable with, let somebody know. And so that was the first step that they had taken towards controlling risk. So basically, what happened then is I really had a passion for finances and being on the investment side, and because of that catastrophe, the career path for people jumping onto the trading floor and becoming one of those guys that I was kind of watching over was much more extended than I wanted it to be. So I made a strategic decision to take everything that I had learned there in a couple years and bring it out to the world of the individual investor, the business owners, and say, how can I apply what I've learned from a risk mitigation standpoint, and how can I apply that to the individual finance world?
Well, and what I found, and when you and I crossed paths, it was when my dad and I were going through the preliminary due diligence and kind of going through like what the heck is going on with our business, what's it worth, what do we need, all that stuff. And we were in the morning crew at the gym, and that you were the sole confidant that I had because I wasn't able to talk about it with my friends, with my family, with my coworkers, with anybody. And maybe give, your observations, because as we kind of intersected, we smashed a bunch of different worlds together on what is it that the business, what are your observations with business owners, with the wealth that they create with the business and what it's worth, and what the situation that you saw that we were dealing with along with all the other customers that you'd worked with, and how that correlates to risk.
Well, it's a great question because you have the small to mid-sized business owners. Typically, the lion's share of their net worth is wrapped up into the business, and to them, their perception of risk is that, in general, and some people, they see industry risk and maybe they're a little bit more sensitive, but in general, people, entrepreneurs are pretty confident in their ability to keep the ship, on the right path. And so they might have a kind of a reduced sense of what that risk is. And, it's just kind of going to piggyback on our conversation that we're going to be having here, is that along with them not fully appreciating how much risk they have, there are so many moving parts on determining what their risk adjusted return is, what they're pulling out of their business, all the different benefits that they're getting from a cash flow perspective to cash flow their current lifestyle. And then how does that apply to what their exit strategy is, or how are they going to get out of this monster that they've developed that is providing a certain standard of living? I see that as being one of the primary issues is people not being able to reconcile what it means to not all of a sudden have that machine, and then really going back out into the retirement world where you're just like anybody else who basically retired with a 401k at that point. You have a chunk of money, and now what?
Well, and I think it's so interesting too, because you and I've had many conversations along with a lot of the entrepreneurs and the friends that I have where, it is risk, but and I think, what's so interesting, it's manageable risk in my perception of what we dealt with in a lot of these entrepreneurs, because it's networks, customers and vendors and situations that you have perceived control over. And what happens is, you've got this whole world that and what it does is it kicks off a shitload of cash. And so you've got your salary, then you've got your write-offs, then you've got distributions. And what happens is you start rewarding yourself for the things that you've done, but there's this big gaping black hole, which, my dad and I realized, and a lot of our clients realize, that what the hell is this thing worth if I were to sell it? Because, we weren't saving money at all. We were using it for loans and for, a rainy day when we actually needed payroll. And I think there's this whole big gaping black hole of, okay, what do I got here? And what is it actually, how do I get out of it if I have to? So what is your experience? How, what is some of the variables? And I don't know if you got some examples on some of the things that people need to really start to dive into and peel apart.
Sure. Yeah. And, just to kind of put a bow on the prior point there, is that you have this business risk that you're facing. And because business is risky and because ownership is risky, the reward for being in that business and operating the business and continuing to maintain that risk is significant. And so what you're doing is you're trying to shift from this high return environment, which has all the benefits that you described, right, to a much more stable environment where we've de-risked from the single small company interest to probably out to more larger companies and market interest and other types of investing that's going to mitigate risk, but also is going to provide a much lower return on investment or spinoff of whatever capital that you had invested there. So,
well, and even before we go on to the example, and I've had multiple conversations, because there's a lot of chatter right now going, we've been in the longest bull run ever. When's the economy going to crash? And, a lot of these entrepreneurs that are baby boomers, do you want to go through another recession, which is kind of scary. But so there's the recession thing, but then there's all these industry things where I was talking to this guy today where they did training. He was actually on the podcast. Scott was talking about how this training institute that he ended up selling that eventually got sold to ITT Tech, and Obama signed a legislation that literally shut down a multiple $100 million company in one signature. So this privately held business that had been, that is the ultimate risk. But you wouldn't see this, you wouldn't see that coming. Or even what's the new legislation that got passed of there's no longer going to be plastic straws. What about the straw manufacturers? I'm sure there's lots of privately held businesses that are that are riding that coattail right now.
Oh, and you have disruption that's happening all across the board, right? There could be regulatory disruption. There could be, you know, any of all kinds of different technologies that are putting companies out of business. And so there is a lot of risk, but like we were saying, the reward is there. So yeah, so let's just jump into a quick example and kind of just take a look at how you begin to take a kind of a basic reconciliation of what we refer to at our company as a value gap, right? And I don't know, do you want to define value gap, Brian, or would you like me to do it?
Well, I'll give my 2 cents and then you can expand on it with your background. So the value gap is what I've realized that a lot of, entrepreneurs or even we experience when you say, okay, so if I'm making X amount of money per year, right? So like, let's say, what's that? Yeah, my lifestyle or that. So if let's say someone's making 250 grand a year through salaries and real estate or distributions or whatever, and you're paying a bunch of stuff, and that's how much you need 20 grand a month to live. Well, you need, if you were to liquidate everything, what does your balance sheet need to look like today to passively keep that? Not so you're not having to exert your sweat equity into something. So if there's a gap between liquidation of everything and you maintaining your income, that's what I consider. You got yourself a gap between you and your target. And I know you've probably got a couple examples, but maybe a little bit more technical way to describe it.
Yeah, so we'll just kind of run through a very typical example that we like to use, right? So let's just say that we have a company that has $10 million in revenue, right? And we've got a couple, say, two partners, 50% owners in the business, and each one of them has saved up a $500,000 in their whatever their company retirement plan might be, each making $150,000 a year, and then maybe with some benefits and some fringe benefits and distributions, maybe they're living a $350,000 a year lifestyle. So really, the business is, to replace that overnight, we're looking at getting them a $350,000 income so that they're not needing to make major expense adjustments when they pull the trigger on whatever type of a deal structure for an exit or succession that we're talking about.
Mm-hmm.
So company's got $10 million in revenue. Let's just say hypothetically that they could get, or that they have an EBIT of 10%, right?
Mm-hmm.
How do you feel about that figure?
Well, and I think, for the listeners, I know we talk about EBITDA a lot, but just call it net operating profits or some of the free cash flow. And I think 10%, I mean, yeah, typical, like, let's just say, on an average up and down the street business is 10% after all that.
And then maybe assume like a 4X valuation on something like this, just for our example.
Yeah, I think, we've had multiple other podcasts about this, but I think, how you value a company and whether it's a 3 times return, because again, an investor wants a certain rate of return or a certain amount of years that they pay back. Yep. 3 on the lower end is because they have a lot of crappy operating procedures or they've not done a lot of things. And then you get up into the higher valuations if they're locked tight. But let's say they're run like a normal lifestyle business 4 times.
Yep. Fair enough. So we have, $10 million in gross. They were kicking off, $1 million in EBITDA, and we get a 4X valuation, and we're looking at a sale price of $4 million, right? So $4 million, fantastic. Seems like a big number. And then we start to drill down a little bit further. Well, we have to pay taxes. We might have debt, outstanding debt. And then, of course, we've got 2 partners. We got to split that up. So to walk away with all said and done, especially if it's not planned out right, I mean, you can really take a hit on those numbers. So let's just say you walk away with 750, maybe up to $1 million a piece. Right?
Well, and I think for the listener, because we've paid the tax man. Trust me, you see my dad's face or any of these owners that we've worked with.
Yeah.
The asset sale that a business owner typically does in the main street, because if you're working top level 2 million in EBITDA and above, you might be able to do a stock sale at capital gains, but asset sales, they're ordinary income if you get the lump sum. I memean, you hit the highest tax bracket immediately with no tax planning, and then you pay it on debt. I mean, it's easily, you can get to that 800 to $1 million with, I mean, it's half.
I know it is, and it's so common, isn't it? So, okay, so let's just use that. Let's just use $1 million for round figures though, because it's not going to make a huge difference whether we got 800 or 1,000 walking away, because we really only have $500,000 a piece saved beyond that. So just for real round figures, let's just say we have $1.5 million. We're walking away with $1.5 million to show for what we've been doing for as long as we've been in business as an owner, right? So let's just say we're 60 years old, not looking to necessarily start something back up. When we pull the trigger here on whatever the plan is, and again, how all these numbers shake out are going to help us define what options we have. Sometimes we run this analysis and there is no option other than to continue to operate the business because the value gap is so high that we need to stay in that business and grow it in order for us to come to a place where the owner's in a position to be able to do this. So we had a couple owners who were living $350,000 a year lifestyle, and for the sake of real simplicity, let's just assume that they don't have any other sources of income. They haven't diversified into any type of real estate holdings, which is something that you do see. And obviously, Social Security is a source of income, but that doesn't move the needle on a $350,000 lifestyle, right? So we're walking away with $1.5 million. And if we're just using a real shoot from the hip spin off of cash flow, we could say, we can pretty conservatively get somebody a 5% distribution off of that. That's sustainable. So you're looking at, $75,000 a year in income, just kind of on a real top level basis here, $75,000 a year. And so the real awakening is when you start to run through the personal financials is that these business owners, they really have no idea what that number means and how they're going to bridge that gap. They just know that they're kind of stuck in a business at that point.
Yeah, and it's paralyzing, and I think what's even probably more paralyzing for most is they don't even know those baseline foundation numbers. And can you dive in a little bit more into like this cash flow piece? Because I think there's a lot of people that probably don't know the underlying assumptions behind there. So, because I think people go, oh yeah, because I hear it all the time. And honestly, we used to do it so we make, okay, we got $1.5 million. You literally just take, 1.5 divided by 350. And then you look at your expense, I'll figure it out for 5 years or something. But like, where's the 5% coming from? And what are the assumptions that you're making, with those two different, the 1.5 and the 5%?
Absolutely. So we have a number of different variables that we're solving for, right? So as I alluded to earlier, whatever the big picture is for the resources that an individual has saved up for themselves. So, some of them have passive income, they have, various real estate, all of these different things are going to come into play. And as soon as we boil it down, we find out exactly where the potential for ongoing income is for the client. We now start solving backwards and we say, okay, we need $350,000 a year. This is an extreme example here. So we need $350,000 to finance our current lifestyle. 1.5 million. What type of risk do we need to take with a $1.5 million base to produce the most income? So ideally, when a client comes to us, we have the value gap is smaller, non-existent. And then what our philosophy tends to be, and it comes down to the individuals and their appetite for risk, but we generally solve backwards and we say, what's the least amount of risk that we can take on for this individual in order to achieve the cash flow needs that they have, right? Mm-hmm. And so to go to your question specifically on the 5%, we start from what is the risk-free rate of return and how much can we get risk-free for an individual. Right now on a risk-free basis, we're looking closer to, maybe 2%, call it. So 2%, we're talking about, $30,000 a year income for this individual on a risk-free basis. It's not going to happen. So generally, everyone uses kind of a different rule of thumb, but the further we get up from 2% is just purely a measurement of the risk that we're going to take. And the market does a long-term average, on an inflation-adjusted basis of right around 7%, and that's fully invested in the stock market. And what really makes me nervous is when I see people modeling, 10% distribution rates off of their money when the market doesn't produce 10% all in, right? And so all we're really looking for to come to that number is if we diversify a portfolio and we're managing for risk, for any given level of risk, what is our comfortable distribution rate off of that nest egg in order to provide a sustainable income for the individual. So we like to benchmark just kind of right around 4 to 5%, and it's just really a starting point. But if the client needs a lot more income than the situation is going to provide for, then we need to slide up the scale a little bit, and that could go 5%.
And I think your point of this is like this person in this example can't sell their company. I mean that's really the reality of it, right? And so, look, because I think we can talk. I think this will be kind of fun as we can talk about all the different ways to bridge that gap. But for the listeners, on rough guesstimates, what would this person need in actual proceeds? Other than that $1 million, what would they actually need? So that right now they got 1.5. What would they need in order to passively kick out that 350?
Yeah, unfortunately, where I would like to see this individual, I would like to see this individual walk away with $9 million to produce that 350,000. And
well, and here let's take this even like let's reverse back up for the listeners, because here's where this gets really crazy. Because okay, so if they need to walk away with $9 million, so you're saying they need $10.5 million for that 350?
They need to have $9 million after tax.
I'm sorry. Yeah. So you're $9.5 million. Yep. So essentially, now think about if you paid 40% in taxes in your debt. So if you gross that back up, think about how much the company needs to be worth.
Right.
It's ridiculous.
It is. So there's a serious reconciliation that needs to happen. And so
then let's say, Brandon, that like, okay, right. Let's say I'm the owner. I'm looking, okay, there's no way. Yeah. There's things that I could do. Maybe I could get it up to $6-7 million or something like that. I've got a little bit of energy left. I got some kind of, stride to do this, but there's just no reality to that. Let's maybe talk about, and then we can get into the deal structures and the exit options. But even before we get into the deal structures and the exit options, let's talk about how different variables in people's lives can mitigate or diminish how much they need. Like, okay, so let's say you're bringing in cash flow from your building from real estate or other things, kind of give us some random examples of how you could, do you understand what I'm saying? Where like you kind of dwindling down how much you actually need from the actual business versus, other different areas.
Right. And yeah, I was just talking with a client here this week, and we manage, he sold businesses in the past. He's building another one, but sold business in the past. And he's of the mindset that he's going to build the business, and he doesn't know exactly where he's going to go with that value. It's very much cloudy, like it is for a lot of entrepreneurs, a lot of business owners. But he's actively looking for diversifying out of his business along the way. And so to take those steps, to be able to take those steps early is huge. So he's in his mid 40s and he's looking to work another 10 years or so. But on the way here, he's making some investments in real estate and some other things that might spin off, some private equity type investments that might spin off of cash in the meantime that can be part of that pie and that formula when we start to solve for what the exit options are, right? So it's how do we start to structure in income options, and there's a lot of different things that go into play. And
well, I think, perfect example of that is like, so just for some basic numbers for everybody is, okay, so if you're making $5,000 a month off of rent or something like that from the building that you purchase or something like that, first of all, you get a lot of tax advantages with the building, but $5,000 a month is $60,000. If you reverse that back up, that's what, $1.2 million that you would need. That's less off of that $9 million, right?
Yep, for sure. And then, so any source of income obviously is going to help. But as I'm kind of thinking about this example here out loud, is that the biggest key is that you have this $350,000 a year that you're spinning off. The sooner you get ahead of this snowball and you can start to plan for that income stream, we assumed here that they only had $500,000 saved up. Right? If we can get a head start on that, we can actually start putting money away. That can be a huge part of the formula here. But
well, and can you maybe describe, when we talk about knowing your numbers and how that impacts your timing, your exit options, and deal structure, so what are the things to consider when you're looking at your exit and in your timing and like how and when you get your money? How do these variables all impact that?
Well, I'm not exactly sure what you're asking there, but what I think you're asking is what are the variables that are going to allow us to have the most amount of flexibility in
Right. The
the
most amount of options, I guess, is what I'm saying.
yeah, the most amount of options. Yeah. So really it is propping up this big picture. And that is controlling the expenses, whatever we can do from the personal financial perspective to allow us to shrink that value gap down, because as you're well aware, the less we need to demand out of that upfront cash and what we take and what we pull out of that business kind of in that initial transaction, and the more, and this can be debated, right? But I have a little bit more of an appetite for, to kind of maintain some of the risk in the succession plan. So I like the idea personally of keeping a little bit of the skin in the game, and that can take a whole bunch of different forms, and you can speak to that as well. But in order to, take money over time, leave a little bit on the table, leave a little bit of exposure there, so that we can get outsized returns on whatever type of terms we're looking at in the succession plan.
Well, yeah, and I think to kind of circle back and make it a little bit more clear, I think it's like, and you said it is trying to minimize how much money you need up front when that transaction happens will unbelievably open up options and doors for you. Because what a lot of people try to do is they have a lack of time, energy, or some sort of need to get that lump sum, or they try and punch out right away, which is going to be the least amount of options and the most financially critical situation they can have. But let's say, and I think to kind of open up a couple conversations here is like, okay, so if we have saved up, or we've got some sort of let's say it's $250,000 for easy numbers, is if we know that we've got some real estate that's bringing us $5,000 a month, we've got some money that's saved up, and then we know that we only potentially need a couple $1,000,000 up front. And let's say we've got a $4 million business, we know that we don't have to sell it outright. We can sell maybe to our managers. We could sell part to our employees through an ESOP. We can maybe do a private equity recap, because we're essentially closing that gap, but then allowing for outsized returns because of whatever exit option. I think there's just a lot of people that get backed into a corner because they don't know these numbers. And so maybe kind of explain what you mean by outsized returns and how that lump sum impacts the cash flow and some of those decisions.
Sure. And I think that just kind of as, from a 30,000-foot view, it's trying to bring clarity to what formula you're solving for. So we have all these different variables we've discussed. And the biggest risk that somebody's going to run here is that they are all of a sudden surprised by a sale, an offer, or they're forced into a situation to where they need to sell before they've had any opportunity to make an adjustments to these variables. And, the outsized returns really goes back to the point I made earlier, in that as long as we have exposure to these small to mid-sized businesses, generally speaking, we're going to be compensated for having that exposure. And there's a time aspect of that. So as long as we're exposed, we're going to get returns that are, and when I say outsized, I mean returns that are greater than what we can expect out of the market. So if we have a transition period to where the owner wants to, pull the parachute here, and let's just say we have 5 years of a runway, instead of saying we're going to completely de-risk and we're going to walk away with a smaller amount of money, because if somebody's coming up with all cash up front, the multiple is going to be lower. You're going to have a smaller pool of assets to start from, and then we're going 100% out of that environment where we could maybe get that 20% return from having that exposure. We're going right back down into a diversified portfolio, which is fantastic. I love diversified portfolios. I'm all for it. That's something that I live and breathe. But the reality of that exposure is we're maybe looking at a rate of returns in the market in the 7 to 8%. So if we can double that by keeping in the business, by having some secured notes and possibly leaving a little bit on the table there, and we can do that for 5 or 10 years, that makes a significant impact into what we're going to be demanding out of the less risky assets later on in retirement.
Well, yeah, and I think, to give a couple examples of, rolling that equity, or the couple different scenarios. So, in the situation where you get the lump sum, like someone in this size business, going back to our 4 million, I mean, they have to list it with a broker. It goes on a website just like a real estate agent, and these brokers broker it. And there's not some people care about the tax planning, some people care about some of the things, but I mean, it's just like, you're a real estate agent. When you're selling a house, they don't really care how much you own the house and what your financial situation is and whether you're going to buy another house or rent. I mean, they don't really, their goal is to sell the company. And I think what allows the clarity is, okay, let's say I know I make enough money. I've got a couple of sources of income through real estate, through secure notes. You could sell or finance some of it. You could roll some equity. And I think what that happens is that allows people or buyers, that opens the bigger door for more buyers, because the buyers have to find their own source of financing. They either have the cash or they are looking for creative structures that allow them to take it over. And I think that's where your management team comes into play, or success, your family successors, or it just really impacts it. I mean, you and I have worked with a customer where if they don't need the money, then they can have really creative ways to transition it to the management and the kids. I mean, I just, there's so much that hinges upon knowing your numbers and opening up this door. Then you and I have talked a lot about private equity recaps where, you don't need the 30%. If you make enough money down, then that oversized return, I don't remember what it was. Like, I mean, they're averaging where sometimes they double their money on the second bite of the apple.
Oh, no, absolutely. And, and the reality is that if you're not running this analysis well in advance, what options do you have if all of a sudden something happens and there is a triggering event that's forcing you into sale? Yeah, if the more flexible you can be on the terms, of course, you're going to bring more buyers to the table, which is going to drive the price up. You're going to potentially have more opportunities to maintain some exposure while you're doing whatever type of transition away from your activity in the business. But worst case scenario is that you're forced into a transaction, and we see this where a sale needs to happen. The sale needs to happen. The market defines what you get to walk away with, and the only adjustment that you get to make at that point is to your expenses. And that's, again, absolute worst case scenario. And that's what you and I kind of live and breathe every single day, is trying to give people the flexibility so that the final adjustment doesn't need to necessarily be made in a dramatic fashion, which is to your lifestyle and your expense level.
Well, and let's take an example where, someone doesn't know these numbers and they get this random out of the blue offer that seems like a big, like, again, hey, we're going to buy you for $4 million. It seems great, but, explain how when people go through the process, how all of a sudden, if they don't know these numbers, how it impacts negotiation, and how, like, when they get to the altar, how things can be so dramatically different.
Yeah. So the one thing that we know that's a major risk is the surprise offer. It's the surprise situation where the snowball starts, right? And the expectations are set. The business owner, all of a sudden, he's eyeing up. He sees that big number. He hasn't done his homework. He sees that gross figure before terms and all kinds of things and taxes and everything have been applied, right? He sees that number. Maybe employees find out about it, and it's a train that's very, very difficult to stop. And most of the time, the people who are driving that train are on the brokerage side of things. And it's just like a realtor selling your house, where they really aren't incentivized to squeeze, the extra margin out for you, because it doesn't really move the needle on their compensation. They're looking for volume. They want to get your transaction. They want to get your transaction closed so that they can get paid. But it's the surprise that starts, that triggers the momentum. That's very, 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 very difficult to slow down or to stop or to get out of.
And then finding out that afterwards, when you're at the altar, that you're not going to have enough money. And, how many stories you hear where, like, and again, I did it, and I know a lot of these owners do, where you sign a non-compete. So your normal knowledge and your industry experience that made you all this money, you sign this non-compete, you walk away, you don't have enough money. And all the ways that you can make money, you've literally eradicated yourself from that industry. So you can't go back in and make the same amount of money, even though you don't have enough, and that whole train drug you through the goal line.
Yep. It's so true. And, just going back to the many, many podcasts that you've done, and you've had guests who've talked about all the things that you can do, obviously, and planning is always a theme. right? And so there's all kinds of things that we can do and that we know that we should be doing as business owners to provide a lot of that flexibility. But I think that the one thing, and to kind of the point of today's conversation is that we can even be doing these things that are value drivers for the business. We can be doing things intelligently, setting ourselves up to have the options and the opportunities for multiple different types of options and terms. But you really have to boil it down to what is your number. And if you don't have that number, it is paralyzing. It is, the business can be all roses. Everything can look absolutely fantastic. There might not be a surprise offer. You're doing everything right, but there is no goal. There's no end in mind, because even when everything is being done right from a business standpoint and running it and everything is streamlined, growth is doing great. You're evaluating how buyers are going to be looking at you to get the highest multiple. There still is this paralysis of, okay, when do I get off the train? Like, what's my number? How do I know, as great as everything is here, how do I know what the net is? And how do I know what's a reasonable risk adjusted return to expect out of all these different resources that I've accumulated, whether it's the business or whether you've diversified? Social Security, obviously, again, a small component, but your after-tax savings, your retirement savings, everything factored in, and how and when to pull the trigger on these various income options. All of these variables need to go into the computation.
Well, and what's your number? But what's your numbers, I would almost argue, because what's your lifetime cash flow? How much money do you have and how much money do you need? And how does that whole jigsaw fall together? Because it's going to impact everything, because you might not need it all up front, and you just knowing when and how you need those liquidation events and that to drive into that lifetime cash flow. Because going back to your story about the brokers, I mean, like, knowing this stuff before you hire a broker is extremely important, because there's lots of times where you could literally, if you have all your numbers and you have your whole structure set up, it's more advantageous for you to sell to your management team or to your family or to all these things, which you don't need a broker, because why would you hire an Edina Realty rep when you're going to do a reduced price contract for deed to your kid? It makes no sense.
Right.
And you wouldn't do that if you needed the capital up front.
No, I totally agree. And the other thing is that, depending on the terms that you're going to have with an internal sale, you may be forced in that direction based on the fact that even if you were to get all the cash up front, even a nice multiple, right? A nice multiple paid up front, you have a fantastic buyer. They're going to come in, they're going to pay a premium. So often the value gap is so dramatic that even under the best case scenarios for the deal itself, there still is a better solution in the terms of doing something internally, because again, you can maintain some exposure to that business. You can take it over more time to get those returns that are going to fund you through different milestones that might be gaps to additional sources of cash flow in the future.
Well, and I think even going back to when you mentioned terms, it triggered a thought where, like, okay, so great. When you talk about risk in terms and having that note, going back into your old world and your lingo is, so there's, you might be able to seller finance on a loan or a high interest loan, seller's note to your management or to someone. But the reason that you're getting an outsized return is because there's risk in that person making sure that thing continues to kick off cash as you step away. I mean, I don't know how many times I've heard where, like, oh yeah, I sold to my key manager, I went down to Florida and the whole thing went to shit. And a year and a half later, when I was totally unplugged, I had to go take it back because technically that $4 million note is not paying anymore. It's like a junk bond.
Oh, for sure. And that comes back to, conversations that we have ongoing with our clients. And that is what's our evaluation of the risk of being in this business? If, ultimately positioning yourself so that you can be completely out is the best place to be, right? So if all the stars align and you can completely de-risk and we see that there is a heightened level of risk in whatever industry it might be, and we can talk about all kinds of industries that have been blown up and disrupted over the last 20 years. The idea is to have that flexibility there, but it's getting a grip on the risk. And there are industries that are doing fantastic, and we have people who are really looking forward to taking that second bite out of the apple and doubling down, maybe taking a little bit off the table, but doubling down, pulling away from the business a little bit because they're maybe not the individual to drive growth because they're their energy is lowered, or whatever's happened to get them to want to step away. So
Well, and let's actually. I just it made me think about a lot of the people that I'm really good friends with, and or even myself, and these people that talk about owning companies that kick off cash, and you've got them so well run that it's a punch card. You just you're clipping the coupons, and you're making money. What are the people? What would you say to the entrepreneurs that have such a well run business that they are quote unquote the chairman or chairwoman or whatever it might be that is just collecting the distributions? How do you reconcile all of this with those people, and what would be your advice for them?
well, and you and I talked about this a lot, and there seems to be kind of this consensus, and maybe it's just from my experience that it seems like consensus, but business owners, when they're ready, they seem to be ready to be done, and they tend to want to get out. Where if there is an opportunity to structure in, like, it doesn't just have to be from the sale and maintaining exposure from terms, but if you can actually participate at that board level, or from some type of a step back level, or whatever it might be that solves your problems, on a real healthy business. I mean, that really is being able to maintain that interest. That's my personal goal. I know you like the idea too of having businesses where you don't necessarily need to be seriously involved in them, but through what you've built, you've developed the flexibility to kind of maintain some income stream from it on an ongoing basis. And that's difficult with a third party sale, and a lot of times a little bit more feasible with an internal transition. But those are the exact things that we're working through with everybody.
Well, and I think you layer on estate planning with that. And my thoughts for people that are in that mindset is you're still going to end up kicking over. I mean, like they're still gonna have to drag you out of the corner office regardless. So, setting it up so that way it transfers through estate planning to your kids, or the management team, or to the right. I mean, it's still an asset that's going to go away that you can't take with you. So, I mean, you're still going to have to, even though you can, make the 350 maybe till you drop dead, there's still other ways to mitigate that. So that way you don't leave everybody else in like just an absolute shitstorm.
Right, and it's the planning, and it's having a design in place to design whatever it's going to take to finance the lifestyle you're looking for. And if there's an extended transition that we can take advantage of there, it doesn't have to be forever or till death, but that can get us through some of those years where the expenses are going to be higher for some reason. Maybe we have a house that's not paid for. We've got a big mortgage, a $5,000 a month mortgage. That's a significant part of our expenses. Maybe there's a transition that gets us through one of these milestones that kicks off and turns off a serious expense. So everything is designing for the clarity and the numbers that it's going to take to really not have the client take a serious hit to their lifestyle.
So, and you might have just even kind of wrapped it up there, but if with all the different things that we've talked about, what's one thing that you want to like highlight, make sure that the listeners are left with, or if there's something that we haven't covered, how would you wrap it all up, and what would you leave them with?
I would definitely say that the integration that we do with the individual's interest, the owners themselves, right? That planning at the personal level for the owner, that's separated from the business but tied to it, and really taking the time to dial in on what the owner's personal financials look like, and what's the reality of where they're at, how old they are, the likelihood of future income, getting all these things balanced out, so that along with these fantastic decisions they're making for business growth and operations in their business, they have this side conversation that's happening that really is more integrated than a lot of people give it weight to. So I would just encourage people to drill down, throw everything into the hat, find out what we need to be working on the personal financial level alongside the business, to give you the flexibility to just hyper optimize whatever exit options that we're working on.
Well, right. And I think, to wrap a bow on that too is, a lot of us, I mean, I think about what my dad did and how all the risks that we took as we were juggling payroll and all the loans and all that stuff is like, you do all that because you want to be rewarded for it, and you want the control, and you're dealing with the risk in order to have the control. And what you realize when you get to the altar is you have zero control over this if you don't know your numbers. I mean, it's just it's a shame.
Yeah, and it's difficult because you know the owner is in a sprint, right? They're putting out fires, they're trying to grow, they're doing all these things, and a lot of times the last thing, and we see it in retirement accounts. The retirement accounts are typically not as well funded as somebody who is working for a publicly traded company, and they know their 401k is the only thing. So they're just trying to drive the value of their baby because they look at that as money being socked away, but there's really no end in mind. And that's really what I would encourage everybody to focus on.
So if our listeners want to get in touch with you, what's the best way?
Yeah, I think just check out the website, the GEXP website, and check the team out and get in touch with any one of us.
Thanks so much. It was a long time coming.
All right, it was a pleasure.